Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I'm delighted again to be able to speak to Judith MacKenzie of Downing Asset Management, one of the UK's finest small and mid-cap investors. So welcome, Judith.
Good to see you, Paul. Not feeling fine at the moment, but never mind. Yeah.
Well, when we last spoke at the beginning of the summer, you were absolutely spot on that being pessimistic on the market, and that's how it sort of proved. We've had a couple of bear market rallies, but I think economic gravity has unfortunately won the day and brought the stock market down, particularly in the sort of small cap area. But putting all that together, what's your sort of outlook now going forward for sort of like the next 6 to 12 months?
Come on, you know I don't do short-term stuff. I don't do macro. I'm a hobby economist, not anything else. So don't take what I say as any gospel. But I think short-term is going to be really bouncy. And but I think in the long term, it's still a great market for smaller companies. And the UK is looking cheap compared to other countries. But somebody said to me the other day, it would be great if the stock market could shut, say on Friday, and you just open it up again in 2 years' time. And he said, what stocks would you buy? And it really got me thinking, because actually it's quite a cathartic way to look at it. We're getting so bounced around by the macro news and everything that's on in politics at the moment that it's very easy to become an economist and try and forecast the future. But ultimately we're stock pickers, and actually I look at our portfolio. I know we're going to talk about some of them later, but look at our portfolio. And these are the types of companies that you just shut your eyes and hold on to the next couple of years. I think we do need to just be very focused on what the fundamentals are and survivability as much as anything else. It's going to be really tough.
Yeah, we've certainly had a few economic and political bombshells, certainly from the Liz Truss brigade on the LDI pension. Now, just actually, what's quite interesting is such that, have you seen anything on the sort of like broader, just across the whole patch, just sort of broader redemptions on fund managers? Because essentially that does seem to have hit quite a lot of good quality stocks, particularly on the value, where people have had good news and they've just been used as a source of funds, which is just like totally unfair, but that's the reality.
Yeah, that's also an opportunity. In the good old days, you used to have a bit of good news coming out and the share price might go up 3, 5, 10, 15%, who knows? But now on good news, share prices we're seeing going down between 5 and 10%, which seems really crazy. But actually that for us is quite interesting, because as we're going through this earnings cycle at the moment, as you probably noticed, there's a lot of statements coming out that are obviously quite backward looking and then cautious for the future. So if you can get a statement that's coming out that's giving you more up-to-date information and the share price goes down and you get more certainty, that's a great time to be buying it. But I am slightly worried about the run to the high hills from some of the retail investors in small cap not companies, but funds. That is quite damaging. But you do tend to see that at this point in the cycle. And what it means is that when the cycle turns, small caps turn even quicker than their larger peers. So, it's not pretty, but actually, fundamentally it provides the opportunity, doesn't it? So we just put up.
Yeah, and I think you've got, not only have you've got a few redemptions, so you have this sort of sentiment side and technical side, but also it seems to some good companies actually are holding back, potential good news. I mean, there's one company that you really sort of like piqued my interest, which was Ashtead Technology last time. There's only 4 months ago, real high quality, sort of like it does underwater submersibles and oil field services, but also services a big chunk of the offshore wind industry up in Scotland. I think it's about a third of its business now, and it's absolutely flying. And I looked through the numbers, and I was struggling not to upgrade its numbers, to be honest, from his and so consequently, I think management. I don't know if you're saying, if you could just talk a bit about that particular company, but also just broadly, if management are sort of like really taking quite a cautious view in terms of the guidance they're giving.
Yeah, I mean, and to be honest, why wouldn't you? Would you not do the same in their shoes? Because
true.
You're not going to be a hero if you put out an ambitious statement. You're not going to get re-rated on the back of it anyway. So at this time, being cautious, I think, is when we speak to management teams, we'd much rather they do that. Yeah, Ashtead is a lovely little business. I could probably put it in the same sort of bucket as a Ramsdens as well. Where you've got, it's maybe not going to be a 2 or 3 bagger, but you've got really good quality of earnings, got a really good return on invested capital, and you've got a good strong management team that have been there and done it before, and you can see through the ages, through the cycles. So they've also got that kind of optionality where they hire their fleet out, obviously, but they've got the benefit of being able to sell it as well. So they sell quite a lot of their hire fleet when prices are right. So that feels like quite a nice place to be. But yeah, we're definitely seeing. The other one that did made a statement a bit like that was a company called TheWorks, and many of you might know that from the high street is basically the sort of budget end of books and toys. WH Smith and a different guys really. They put out a statement. I can't quite remember when it was, but probably about 3 months ago. And you would have thought that the world was coming in on them. And then they put out the full year numbers, hit the numbers, and then also upgraded. Well, when I say upgraded, they gave expectation or updated on September trading. So you had much more confidence. Their share price fell probably about 18–20% on the back of that first statement, but then went up about 35% on the back of the next one. So, I think poor management teams are damned. They can't get, if they say too much, then they are going to get killed for it. And then if they say too little, they're going to get killed for it. So yeah, I do have a degree of sympathy.
Yeah, I mean, just on just point investors to Ashtead Technology that I mean, I've run the numbers, and I looked at. It's difficult to put a sort of like an appropriate multiple given the cost of capital, but I was using a 10 times EBITDA multiple because it's high quality, really flying this business, driven by the energy. And when you do that, you can't get anything less than £3.60, which is compared to a share price of £2.50, and I think you tipped it to me about 180, so I should have bought.
Yeah. No, it's, as I say, really steady, and you could see that there's upgrades coming here. They're very ingrained in that renewable space, as you say, and also oil and gas decommissioning. So it's just that it's the sweet spots that you have to hunt around quite a lot to find growth at the moment, but growth in those sectors is not difficult to find. And then again, you look at their peers, they're probably on a 50% discount to their peer group, I think, in terms of multiple. So yeah, you could quite easily see it 10 times.
Yeah. And then just on that, just finishing off on the works, I mean, as you say, it's a sort of like a reincarnated sort of like, WH Smiths and stuff, but it's a value sort of play. It's a value discount, isn't it? And you would have thought they'd be doing okay. And I'm with you in terms of their last quarterly statement, like for like figures. I think they were positive in terms of sort of 6 or 7% up, like for like. So,
yeah. There's a lot to like here. You've got 60 million in cash on the balance sheet. It's about 60 million of EBITDA. Margins are now, I mean, this type of business is always going to be quite low margin, but margins are now about 6.5% or thereabout. The consumer's got to be trading down over this period. We're still going to go out and buy, I'm sure.
Certainly for Christmas, they're going to be trading down.
Exactly, I'm sure are. And it's at the operating level, it's generating about 20 million in cash, and it's a 21 million market cap. So I think it's on something like ridiculous, like 1 or 1.5 times EV EBITDA.
Yeah, I think you're right. Yeah, about 5 to 5.5 times PER, and it's got a shed load of cash. So.
Yeah, and it's a sensible management team, as you've seen by the statements that they've been putting out as well. So yeah, and I think you get a divvy of about 2.4p as well, just for holding on to it. So there's a lot to like about it. I think in these markets, it's very easy to look to be defensive and look at things that have all got net cash in the balance sheet, which we do like, by the way. But are maybe in sectors that aren't in consumer and aren't in those areas where you're seeing quite a lot of profit warnings. But using that analogy of shutting the door for 2 years and wondering what things would look like in 2 years' time with a company like TheWorks that's well run with net cash and balance sheet and isn't doing a crazy store rollout, then I would like to think that it's going to be well ahead of where it is at the moment.
Well, you'd have thought, but given the more austere environment, it will certainly. It should have chimed with consumers. Now, I mean, look at Poundland. Everybody's queuing up outside to get into it, and Aldi's. So they'll be doing the same for Christmas for their decorations and stationery, and back to school. In fact, I guess it's probably doing pretty well. Now, another one. I tip my hat. Congratulations, because this morning you had some very good news on the Hargreaves Services, and they are sort of like quite interesting. Unbundling play as much as anything. They've got a land bank they do on sort of property development and commercial stuff, and I think they've got some sort of like renewable energy in there with some wind farms and stuff, as in like that. They use the land for that. They've also got, they're a contractor as well, so they build stuff for people, and they've got a sort of like an industrial products trading business out in Germany. So they're sort of like quite a mishmash, but they were trading at sort of like less than 5 times PER this morning, and then they came out with some really good results. So you must, given it's one of your larger portfolio positions, I bet you're quite happy about that.
Delighted. The price went up. The price went up.
Yeah, I know.
Like, yeah, no, very happy with it. I think you're right. You know, it's a little bit misunderstood. If you mention Hargreaves to folk that have been in the market for a while, they'll say, oh yeah, that used to be the largest producer of coal in the UK. And of course, coal's a bad word, isn't it? Now they've transformed themselves since those dark days, and we got involved when, or I think probably were involved in Roger McDowell going onto the board.
Yes.
An individual that you've probably come across before, and he's also in Flowtech Fluidpower. And he's, what I like about him is he puts his money where his mouth is. He gets them on board, and then he does a little bit due diligence, and then he typically puts £1 million in himself. And I think when somebody's putting £1 million with their own cash in at quite an early stage, find that they're probably going to create a little bit of change. And here you've got so much optionality. You've got the net asset value, which is probably double the share price, and that's based on land that's outside Edinburgh. Now, okay, we can all take a long-term view on, a short-term view on housing, but the long-term view is that there is a UK need for it, and Edinburgh sites I know are very much up for grabs. And then you've got as you say, the German business, which doesn't quite fit necessarily, so you can see a sum of the parts argument as well. So there's great optionality here, and I actually think it's got much further to go. I think it's really only beginning to come of age. So yeah, we're certainly continuing to hold on to that. In fact, probably looking at buying some more.
Yeah, and I think that certainly with that land, there isn't certainly the different usage potentially is to effectively rent it out to wind farms long term, or to, I think they've got you've got incinerator, a waste to energy thing in there as well, and those we need them. I mean, the UK needs that type of sort of like area and facilities. So all good. Now, another one which is, I mean, you seem to be packed jammed, actually, some really good stuff. One of them which is absolutely flying, Equals. Now, this one is sort of like gone from, I think you kind of came in, I can't remember, about 50, 60p or something like that. And it's about 80, 90 at the moment. And it's sort of like Forex, it's e-payments and international Forex sort of like platform, etc. And it's obviously hitting the ball out of the park, because it grew revenues by 80% in the first half, and I think the Q3 at the last trading update was pretty strong as well. Yeah.
I mean, record results really. I mean, I've got to thank you for this one, because this is one that you managed to get me interested in when I was watching one of your, I can't remember who it was with, but it was probably with the management team, I suspect.
Yeah, okay. Ian Strafford-Taylor.
It was Ian, yeah, I think it was. And he's nicely dry but enthusiastic at the same time. And I certainly I didn't quite believe that this little company could actually be stealing the lunch from some of the big banks. But they've got such a neat, almost kind of app-driven type solution that it's just common sense. And I think you've got a price target of about 152 or thereabouts.
Yeah, that's right. Yeah,
I'm a little bit below that at the moment, but mainly because again, they're a company that are really good at giving you a kind of quarterly run rate, so you can do your own forecast. So I'm probably a little bit behind you on that. I think I'm about 142. So
okay, well, we're not too far out the ballpark.
Yeah, we're not exactly too far out the ballpark, and I think I'll be the one that's thinking I'm wrong. There's bound to be further upgrades here. It's a good, solid management team. I'm really impressed with the last time I caught up with him, with the methodology around the sales process. You've got some good people. They feed their funnel, and it's a pipeline that really is monitored all the way through. They don't just let salespeople go out into the field and do their own thing. It's very disciplined business.
Yeah, no, I think likewise with Ashtead Technology, I think Equals has got a strong chance of upgrades, certainly for 2023 anyway, because when you run the numbers, they look as though they're going to be well ahead by the exit run rate for this year in terms of where they're planning to be for revenues for next year anyway.
Yeah, I can't quite remember what consensus is, but for next year, but you must be looking at what, north of 75 million of revenue and 50 million, aren't you?
Yeah, I think that that would be definitely And I think they'll knock the ball out of the park on the EBITDA as well, because they'll start getting some serious operating leverage, hopefully next year, on through their investment sort of phase.
Right.
Anyway, we'll wait and see. Now you've got quite a good selection on the sort of the media side. You've got a selection of B2B and B2C, and obviously this is an area that's not well, should we say, not well liked at the moment. It isn't in favour, but they obviously really got, pretend that some of the businesses are doing really well. Let's start with Centaur Media, because that was the CEO Swag Mukherjee. I mean, he's got this sort of like strategy to increase margins and to continue growing the top line by about, I can't remember, 10% per annum or something. And when you put that numbers in, and I know when I spoke to Richard Staveley not long ago and he's got a price target of £1 for it, and it's currently trading at 41p. So it looks significantly overlooked by investors.
Yeah, well, you've said the sector, and we've got, as you say, we've got a little cluster. This wasn't necessarily deliberate. Each one of these, we take strategic stakes in these smaller companies, and what we're looking for is a catalyst in each one of them. And here, Centaur, if you go back 3 or 4 years, they went through a bit of a Swag came around, went through a bit of a turnaround. They took an awful lot of cost out of the business, about 5 million of cost out, and then they're kind of left with 2 businesses that don't quite sit that neatly with each other. There's no real synergies. You've got between sort of 3 and 4 million of central costs. So bear that in mind when you're looking at the EBITDA. And if you then overlay what Swag has been saying, or they've been saying for quite some time actually, that MAP 23 it's called, so that is margin of 23% by next year, then that gives you a 16% free cash flow yield. So it's chucking off cash, you've got net cash in the balance sheet, and you've got 2 businesses that don't quite sit together, where you could quite easily say that an acquirer would take quite a bit of cost out the central cost. So yeah, and you've got a strategic shareholder, I suppose, like ourselves, and Richard sitting there too. So yeah, I think it's a lovely little business, but I suspect parts of it are ultimately going to be better off in other people's hands. So the sum of the parts, I'm maybe not quite at £1, but I'm in the early 90s.
Yeah, I think Richard was saying it's his #1 pick. This was about a month ago. Yeah, he was. Yeah, it's his #1. He thinks it's going to go, well, a bit like equals, I think, go to the moon, which would be quite nice. In terms of the other one, so we've got another one which has put out I think it was a good trading update on the, is it Bonhill? Was it? No, is it Digibox? Doesn't Digibox is sort of a bit B2C, isn't it? Sort of turning. It's more of a sort of like.
This is your direct consumer. So you look at the ad space and ad spend, and of course you've had Google and Alphabet and everybody else coming out and cautioning over the last couple of weeks, really. So why on earth are we holding Digibox? So Digibox own their own titles. They've got the Daily Mash, you might have come across. They've also got the UK's largest student magazine, which is the Tab. And they bring these titles in, and they put them onto their own platform. So instead of going out to ad agencies and trying to get the best optimization, they actually do that internally themselves. So it means that they can drive 70% type margins, and it's quite a small business. So I think in the first half they did about 1.9 million, and they're looking at 4 for the full year, but they tend to be heavily about 68% weighted towards the second half. So we're feeling okay about the second half. Net cash will be around about £3 million. It's £12 million market cap. It's a real tiddler. But again, I think there's going to be some great opportunities in this space, because those that are less efficient are going to get absolutely pounded by the volatility in ad spend. And really what we need on this platform are more titles. So that's really the tactic with this management team. It's, again, a nice steady management team that like to generate cash as opposed to spending it. So yeah, we'll be, I suspect, holders of this one for the longer term. Yeah.
And I think with advertising, what seems to have happened, I mean, Meta came out with the old Facebook business, came out with its numbers, and obviously they've got slammed today. It's down about 20%. And what they were saying actually was that their pricing for advertising has actually gone down 18% like for like. And that's hit because of the Apple, unbundling and stopping the cookie tracking, which happened about a year ago. But equally, there's been a proliferation of advertising inventory onto the industry, the likes of the retailers, the Walmarts, the Amazons, and people like Apple as well. So you've got it both hit both ways, unfortunately, on the digital side.
Yeah, it can, which is why, you know, we've been very selective in where you've got to have for us, we've got to have a strategic angle. We've got to have a catalyst that is not necessarily market dependent, and where you're just trying to drive market share. It's all quite niche, that the businesses that we're looking at here.
Yeah, another one was Bonhill, which was doing fine as a turnaround, and I think it's had a bit of a softer patch, hasn't it? And it's sort of like looking sort of like strategic review, which says to me it's unbundling opportunities there.
Some of the parts, I think you might call it, whatever.
Yes, exactly. Yes.
Yeah, exactly. I can't say too much, but it is obviously in the middle of its strategic.
Yes, of course, yeah.
It's a highly acquisitive sector, and you know, you look at the brands that are there. They've got.
It's in financial services, isn't it?
Yeah, and I think that's really what kind of made the board think, gosh, you know, we're just about to go into a period of recession. Financial services do tend to sort of take the foot off the gas when it comes to events and advertising, marketing spend. So yeah, I think it was just a degree of caution, and I suppose to a certain extent as well. You know, you mentioned Richard before. He's a big shareholder here, as we are, and we've been holders for a while, and we probably just want to get some realization out of it. So we didn't really want to sit through the next cycle. But I think from where the last fundraising was and where we are on potential for some of the parts, you've got to be talking north of 18p. So I think we'll still do okay out of it. Yeah.
Well, when you buy really cheap, then you've got a chance, haven't you? Even if he goes through some bad patches, it gives you lots of safety of, you know, margin of safety, isn't it? So you got potential upside. Yeah. Now, the last one on the media side is National World, which is sort of like, I think the guy who's taken on board is sort of an expert is a serial sort of media expert and newspapers guys, and I think it's about 80% is actual print news and about 20% is online. And the idea is to take it into, I think it's regional titles like the Yorkshire Post and I can't remember. There's a couple of others, isn't there? So how do you see this, and what sort of interested you in the National World? I know it's super cheap.
It's so you know we're a notifiable shareholder now. So. And well, I suspect we'll increase in size as well in due course on bad days in the market. So I don't know if you remember Johnston Press.
Yes.
A bit of a swear word back in the past, because remember, I think it had a pension deficit. It also had a massive printing press, and there's no scandal. Well, hopefully no scandals in their closet either, like some other newspapers have. So the play here is, as you say, moving from that print-related market into digital. And actually what that does, it widens up your international markets as well. So they say they've got a title like the Scotsman, which is very strong in Scotland, but there's lots of expats in the States that now pick up the subscription of the Scotsman, which they wouldn't do before. So there's that switch, which is quite nice. They've got quite a cash generative business, believe it or not. In half one, I think they delivered about 8.7 of EBITDA. And again, it's very half two weighted business. I think there will be some headwinds when it comes to that local advertising spend, but actually they've got so many things to do themselves on the self-help measures and the margin side of the business that I think we can probably end up fighting through that. And you're buying it on an EBITDA of just over about 2 times at the moment. So it's we think you know, a modest price target on this one would be about 45p, and we're sitting at maybe about 14p today or thereabouts.
Yeah. Well, a bit higher, but you're right. It's not. It's very cheap. It's less than half of. I mean, just as a broader issue. I mean, I'm a sort of value investor and also GARP investor, and we obviously go for the similar sort of things, etc. How do you distinguish between a sort of value player and a value trap? Because that, if you're not careful, if a sector's out of sort of like, you know, out of favor, you can get attracted and a bit too heavily weighted into one particular area that seems great at the time. Like if you'd gone into retail or you got into house building, that would have been brilliant. Sort of, you'd have thought about it 6 months ago, but now actually you'd have been 50% down. Yeah.
No, I think we would always look for companies that, when you're especially going into sectors like this, you've got to have companies that have got their own self-help. So you're not just looking for the natural growth or otherwise that might come through a sector. You're looking for like National World, the margin improvement, cost cutting, the move to digital, you know, cutting off certain lines of business where they can actually keep that margin and maybe even improve it over a tough period. So if you don't have those catalysts, and it's also why we quite like to take quite decent stakes in companies, because it gives us a seat at the table to make sure those catalysts are being driven, because value traps very often are in companies that maybe a little bit old economy, sometimes owned a majority by their family, great cash generative businesses, but they never really do anything. You know, their growth is all right, but it's not really, there's no breakout points. So therefore you do want to have a stake and be alongside other shareholders who can cajole for change when you think there should be. So I think the 2 points, the catalyst and being able to make change.
Yeah, one way you obviously can make change, I think you're quite a big, is Norman Broadbent, which is sort of like executive search, etc. And yes, it's effectively recruitment had a really good sort of like, you know, period over the last year. But if we go, I mean, you had Lloyd's this morning coming out with its update and was actually saying that, yes, we won't get a really deep and severe recession, but it is saying unemployment is going to increase from 3.5% to about top out at about 5.5%. So adding another 2%, which isn't a major issue in historical terms. But clearly in that dynamic, if you just a sort of like a broad brush recruiter, then you might actually be struggling it. What sort of attracted you to effectively Norman Broadbent?
As a vehicle more than anything else, because you know, if you ride the recruitment sector at the right points in the cycle, it can be really quite exciting. So what we wanted to do was make sure that we had a management team and I suppose a bit of a platform in place where we could, you know, you wouldn't want to go and buy one of the top recruiters, say 2 years ago or a year and a half ago. They're really expensive, probably the highest multiples that they had been for 10 years or 15 years or so. But here we were getting into a company that is what 2.5 million market cap at the moment. And we have a plan from the existing base. If you look at the LTIP, you can see that the LTIP is driven towards them from their existing base, generating $1 million of EBITDA. And the management team that have come in are quite, again, a bit like Ashtead. So you've got renewables experience, oil and gas, decommissioning, and so therefore quite defensive in the verticals that they're in. But probably just as importantly, you've got a chair and management team who have been there and done it before in public markets and consolidating. So I think, you know, maybe a bit of a brave move. We took the move before the market was starting to fall out of bed. I think the market and recruitment will fall out of bed, but that will provide the opportunity to acquire, hopefully quite smartly, over the course of the next year or so. And then ultimately, when the whole thing turns again and life is good, then we can flip into something larger. So that's the plan here, really. But it's more like a private equity play in the public markets than anything else, I think.
Yeah, I mean, I found certainly for small, really small micro caps, less than 10 million, that should become difficult to acquire, even if they're sort of like unbundling plays, because people, you know, the difficulty of taking a PLC or a listed company off the market is too much in terms of the, you know, the sort of the cost to actually have to do that M&A.
Yeah, that's right. You know, so yeah, we've got to make sure that we've got our number one, a sleek board and cost base, and also have a shareholder list that is capable of moving. You know, if public markets don't suit it, then you know, a company maybe shouldn't at 2.6 million, maybe shouldn't be on market. I think it does suit Norman Broadbent, and it will do because it's going to be a platform play. You've got to make sure you're alongside other shareholders that are kind of like-minded. And in this one, we've got the Moulton family, Spencer Moulton. So again, he's been involved in this business for a while. So in fact, knew Peter Searle, the chair that went in, who was ex-Spring. So they've made money out of Peter when he was at Spring. So it's nice to have that kind of that bedfellow on the shareholder list to make sure that we're there to fund acquisitions and do things like you'd want to in public markets. And if it doesn't work, then you know, public markets can end up being private markets.
Now, just turning to another one, which has sort of really run the winners, is Ramsdens. You mentioned it briefly earlier on, and the market seems to be moving perfectly into sort of like its sphere of reference, because it's sort of one of the UK's largest, I think, pawnbrokers, but sells sort of like jewelry, watches, and also I think because of the travel boom, because it does forex as well, in cash, etc., and that's gone pretty well. Do you want to take us through that one? Because again, it's trading at less than 10 times PER.
Yeah, this one kind of gets overlooked for its larger peer, HSP.
Yes.
It's been around for a while. I think Ramsdens came to market. I don't think they disappointed, but they ended up, the management team ended up selling stock, I think, probably in the first year or two of coming to market, which I think hacked off shareholders. And sometimes that just leaves a bit of a bad taste in the mouth. But I actually think this is a really good northern gritty management team that I've got an awful lot of time for. So they've got three parts of their, I suppose they've got four parts of their business. They've got the FX side, which of course fell away completely during COVID. That's now back to pre-COVID revenues. It was up about 40% in the last trading statement. And they're also at slightly better margin because there's been so much volatility in FX that they've taken that margin benefit as well. The pawnbroking loan book is actually ahead of where they were pre-COVID. And I think that will continue. So that's sitting at about 8.6 million versus about 7.7. And so that's moving nicely ahead. And I think sadly that might only go in one direction, given the macro. They also buy precious metals. So we buy your gold type adverts. And that has, well, high gold prices obviously benefited them, as has increased footfall. The one part of the, so that's about 60 million of turnover. The one part that I maybe scratch my head or question myself over a little bit sometimes, they're one of the UK's largest sellers of online jewellery, believe it or not. So if you're looking for a second or a third hand Rolex, this is probably the place to go, or certainly would come up in your Google searches. So it's maybe not quite as defensive as some of the other parts of the business, but actually if you look at what they did and how they invested through COVID, their online offering really is pretty much second to none. And they've got obviously the benefit of having the in-store, so you've got a presence on the high street that's not just a pure jewellery presence, it's their FX and it's their pawnbroking side. So that's the one part that's saying that part of the business was also up about 40% in the last trading statement. It's about 26 million worth of revenue. So, and at very good margins as well. So that's the one bit that I'm kind of monitoring. I do quite a lot of going out on a Friday afternoon and wandering around the high street and going into pawnbrokers and seeing what kind of price I might get for my rather dodgy watch or what I might be buying on the other side. So yeah, we're watching that quite closely, but you know, it's a well-run, slick business. They don't have a lot of overhead and got net cash in the balance sheet, and they've got facilities out a couple of years. So yeah, I do think it's defensive despite what I've just said about the jewellery side.
Yeah, I mean, I think no doubt about it. Certainly 20–30% of the country, which still haven't put their heating on so far, is going to be using pawnbrokers more often, I think, because they're, you know, essential part of the social fabric, and they help people with cash to pay their bills, particularly to get through things like Christmas. Now, one area that is which has done really well is in terms of the digitization and IT. Sort of like of all things school and public services is Adept Technology. Now, one of their peers, I think it's Bytes Technology, came out with a trading update yesterday, and that was very positive. So I can certainly get it. You know, in terms of there's a real, that whole cloudifying, moving corporate and public services into the cloud will keep it really busy. Now, the only thing which is unusual really for a downing stock is actually got quite a bit of debt, this company, and with higher borrowing costs in terms of, you know, sort of like, how do you see those? You've got sort of like a strong demand dynamic, and then you've got sort of like, you know, you have to pay down debt, I guess.
Yeah, I think there's a couple of things that overshadow the share price that's quite frustrating. And debt, as you say, so they talk about their senior debt being 29.6, but actually it's probably more like 36, because there's also a convertible loan note in there as well. So it's something that we've been, probably the management team would say we've been whining on about for a while. So they've got great cash generation. They convert about 108% of their EBITDA into cash.
Right.
So we've been very keen, and now the management team have come out and said it, but we've been very keen for that de-gearing message to get out to market, because it's a great little business. It's got, you know, it's in verticals, as you say, like education, local government, very sticky, healthcare, very sticky type revenues, 75% recurring revenues. The other thing I think that's probably overshadowed it a little bit is that they've had a fixed line business. So, you know, remember when you used to have a telephone on your desk, whenever that was.
Yes.
So that fixed line business, unsurprisingly, is in decline. And it was quite a big part of the business. It's now only, sub 10%. So it's become less and less. But so when the company were trying to demonstrate organic growth, that side of the business was kind of dampening down the overall picture. So you really had to look through it to see what the kind of core earnings growth was from the, I suppose, the more attractive part. So that has been a bit of a way as well. But now they said that they're going to focus on cash generation, paying down debt, and that they're going to get to sub 2 times. I think it's by the next 18 months. That should start to satisfy the market. And you're valuing it around about sort of 4 times at the moment. And we think, if you look at the deals that have been done in the sector, it has been quite an acquisitive space. Deals are being done at between 10 and 12 times EBITDA. So we can easily see north of 250 here. And you're sitting on a share price of, well, I don't know, the spread at the moment, I think it's 15p spread today. It's 105, 120 or something. Crazy.
Yeah, no, I could definitely see this one being bought out by Bytes, perhaps. Was that anybody who wants to take?
Yeah.
I mean, it just seems such a, and they've got high, sort of recurring revenue streams, and you just say there's lots of operating leverage for an acquirer that they could then just bolt on very simply without the overhead. It just makes perfect sense to consolidate that, and you pick it up. The problem is that they wouldn't be able to get away with the current share price to be able to do it.
Certainly wouldn't. No, they certainly wouldn't. And you've got ourselves, you've got BGF, you've got some big shareholders in there. So no, this is not the right price.
Yeah.
Just make sure it's
another one which isn't this. I mean, they've had lots of them really to a certain extent, because of it. I mean, the market's just indiscriminately battered good quality companies, and one which has been a sort of like a perennial sort of like M&A acquirer, but equally has done the integration really, really well and moved up market into sort of like higher value, is Volex. And I know we've talked about it before, but it used to be sort of like just a cables business, but really has moved up market into sort of medic and to EVs and to data centers, higher value. How do you see this one? Because again, the shares have really sort of like, come off of late, but the business actually fundamentally seems to be as strong as ever.
Yeah, I mean, it's done everything that they said we were going to do. I mean, it started to catch up with its larger peers in terms of valuation. It was really, really cheap when we bought it. It then started to get a re-rating. And then, the macro hit, and it pretty much halved in value, I suspect, in the last 12 months.
Yes.
I think there's a couple of reasons for that. So as you say, they were kind of the lower end consumer focused type products, predominantly if you go back 4 or 5 years. Now the mix is much better. So they're only a very small amount now in white goods, but I think the perception was that they're going to get stung by that. And of course, that's going to be a headwind, or is a headwind, but they're also the lowest cost manufacturer. So they work out Turkey. And so they are very, very competitive there. But I think people have ignored the move into EV, which is obviously pretty massive when it comes to cable assemblies, also healthcare, for things like CT scanners and big data. But last year, data centers went through a bit of a change in their cabling requirements, and there was a delay in quite a lot of the rollouts there. So you've had that kind of combined effect, so consumer plus delays in some of the data side. But if you look at the working cap for this year, we're looking at probably consume about $20 to $30 million of working cap, and they've got a really good return on invested capital. So this year might be a bit of a sort of a year of a little bit of indigestion, but no, over the longer term, we're very happy with it. And this is one that we've been a holder in since, gosh, I think our first entry price was about 38p, and we've taken all our cash out probably 2 or 3 times, but we're still continuing to buy it for some clients today. So we think it looks cheap at the moment. And I think also knowing a company for 4 or 5 years gives you, or should give you, a degree of confidence in your own forecasting as well. So I think, the market has overdone it, but I can understand why they have marked it down in the shorter term because of some of the headwinds. Perception.
Yeah, and I think there's, it's a good management team. It's Nat Rothschild, isn't it, who's obviously steered that ship really well. And I'm with you in terms of, putting new money to work, etc. If you've got something that you've seen and done and it ticks the boxes, then why'd you start a higher risk position elsewhere when you've got something straight in front of you that you could hopefully do pretty well out of. Now, another one which is sort of like it's got a good management team is Flowtech, but I think it's and they do sort of like pneumatic sort of like devices, but their distributor of pneumatic and flow sort of devices for industry, and it's sort of like I think it's a GDP player as much as anything in terms of, you know, sort of manufacturers. But they've been through a sort of, they're going through a restructuring, and they're sort of like, you know, rationalizing. But the shares haven't really responded a great deal. And what's your sort of latest on Flowtech?
Yeah, you know, they've had a bit of a COVID recovery, really. And, you know, if you're looking at inflation, they're probably, you know, distributors like these guys are capable of passing on costs quite neatly in margins. So, you know, I'm not worried about that. They've also had, as you say, been through turnaround, but some really good self-help measures as well, both on the e-commerce side, but more importantly, coming through in margin too. So we're not overly bullish on our forecast here. We think there's upgrades to come, and we've got a target price of about 185 or thereabouts, and what we're sitting about 105 or 104 today. So you know, there's good upside. I think it will take a bit of time for the market to realize it. I suspect actually what will happen before that is that, again, it could be another takeout play. I mean, I know that everybody's saying, oh yeah, UK is so cheap, and UK small cap so cheap, and US is going to come over, flying over the hill. You know, it's quite a nice narrative at the moment. When I've been speaking to people in the M&A, as we do on private equity side, and also advisors, at the moment, dare I say it, we're just being laughed at as a UK government, economy and politics. So I don't think we have seen some very nice deals happening, but I think we need a bit more stability before we really see too much of that. It's not good to be known as the laughing stock, but a little bit of political stability will allow that to happen. Yeah,
well, and with that sort of like the thread of the management team there, in terms of Roger McDowell is the chairman, isn't it? And I think the CEO Bryce Brooks, who's top quality as well. So yeah, you can pretty much guarantee that they're going to be trying the hardest to make sure the turnaround happens.
Yeah, well, yeah, I think, and you know, all the heavy lifting's been done, really. You know, the last part of the execution. I think if we hadn't, famous words, if we hadn't had COVID, you know, you'd have seen quite a different business through 22. But you know, the work's been done. It is very clearly identified, well articulated to the market. So yeah, and again, Roger's put his money where his mouth is here as well. Yeah.
Now, just on one which is sort of like FireAngel, and I remember we've talked about it, it's smoke detectors and stuff, and they're on a sort of turnaround. And the idea was to really sort of like try and get more recurring revenues in, so you could drop through on that, you get improve that sort of gross margin. And I think they've got the turnover moving up, but they've been hit by some input cost inflation, I believe.
Yeah. I mean, I think, you know, I use the word banana skin with FireAngel quite a lot in the past, and
I've got a few of those.
Yeah, and I think, you know, it's really frustrating, because actually, if you look at what the management team have done, their gross margin improvement was really coming through, and then they got hit by a combination of currency that they hadn't hedged, question mark should have been, and also just a bit of a delay. They managed to get their price increases through, but because of the stock and supply chain issues at the start of the year, they were supplying stock on the old prices, and when actually their input prices were higher. So you've had that kind of lag effect. I'm hoping it's a hangover as opposed to anything more significant than that. But you know, we see the value in this business, not so much now from getting recurring revenues from, say, a kind of Grenfell type solution, but actually looking forward. If you look at the Techem deal that they've done, a big German energy provider, they're providing and are in the development phase of a kind of combined smoke heat alarm for their solution, so really next generation. And I think, you know, there's some big numbers around that, and at some stage somebody's going to, maybe Techem, maybe the large shareholder BRK as well, who are also in the space. It's got some fantastic IP in a regulated market, and they've now proven that they can get the gross margin sorted. So a little bit of luck in this would be quite nice. No more bananas, just a little bit of luck. It's good. We really like this management team. They are capable of executing. We've seen that, but it would be nice to not have headwinds.
And what, just coming out to the final one, Synectics, which is sort of like a CCTV, or they do it for sort of like transport, buses, trains, and also for the sort of casinos, the gaming out in the States. And so it's been around for some time. It was actually the old Quadnetics business, wasn't it? A long time ago. Got cash on the balance sheet, less than 7 times PER.
Yeah. So if you look at what's been happening there with that business, so about 5 months ago, announced that they were on the hunt for a new chair. Great guy, been in place for quite a number of years. In fact, back to the Quadnetics days.
Yes.
And if you look at how the business has changed, so yeah, you mentioned CCTV and you probably automatically think of cameras, but this is now command and control. It's a solutions business. So that solutions margin is much more like 45, 55%, 60%, whereas the old install business is like 3 or 4 or 5%. So you want to move from box shifting into solutions. And if you look at their pipeline now, their order book, 30 million of order book, and that is mainly in things like infrastructure, whether it be railway stations or high-end infrastructure, not your on the street corner in the city of London. So that really is more of a solution, and that's the shift that the company's already made. They took 2 million of cost out of the cost base through COVID, and it should be a 4 million EBITDA business on a market cap that makes it look pretty derisory. And if you look at this, is another one. Look at the LTIP. So we're quite big shareholders here, and we were involved in the structure of that LTIP. So we're looking for, it's going to be 17p before there's any payout, and 24p when management team of earnings, before management team start making money. You just put a modest multiple on that, and you're looking at what, 292 to 340 share price, and on a share price today, it's just over £1. So we think there's something to play for here. There's also been a lot of M&A in the sector. So Motorola's bought up pretty much everything, and it's one of the few independents. So.
Yeah, and one sort of broad point, which comes through sort of like in spades when we chat, is the level of detail that you guys do, and you sort of like, you seem, how important, it's just a broader picture, how important is it for investors, particularly when they go into areas that are sort of like, there aren't that many people who look to build up your own forecast and your valuation, rather than just rely on the brokers, because you guys seem to really sort of kick the tires and sort of like, do the maths on it. You don't rely on as much on third parties.
Yeah, I think it's, I would maybe, if you asked me 10 years ago, I'd say I'd just disregard a broker forecast, but now I've probably got a little bit grayer and wiser. Yeah. And I think, you can't disregard how the market perceives something. It's going back to your value trap argument as well. If I think I'm so smart and I've got it right, and the market's telling me I've got it wrong, then, there's a chance that maybe I've got it wrong. So I think, it really is, it's probably working hand in hand with the broker to a certain extent, understanding how much work they've done and actually where you can get an edge. If that is trolling around a shop on a Saturday afternoon to see if there's 10 people standing outside Ramsdens to get a pawnbroking loan or whatever, that's the kind of diligence that we're prepared to do. And it does give you a little bit of an edge. And I suppose the other thing about doing your own numbers is it means that you're not believing everything that management say, which is again, maybe we hear comment as well. But you've got to be cynical and question and really challenge management. And I think you can only do that with your own numbers.
And also, I think certainly, if you've invested in certain management teams before and you trust them, then you can take more emphasis from the guidance they give, as in like where they see it and how much, and then you read it between the lines. It gives you a feel of sort of what the safety margin is, I guess.
That's exactly it. It maybe goes back to the point that we're making at the very start that some management teams are being pretty cautious at the moment, and we know, for instance, that Ian at Equals is always quite cautious, and he doesn't mind putting through upgrades if he needs to. He's not going to over egg it. He does it on the basis of information that he has in front of him, as opposed to maybe a sort of blue sky forecast that might be aspirational. So as you say, you get to know management teams and how they forecast internally as well.
Yeah, and then just finally, in terms of the big picture, and apologies for asking you a macro question, but anything that investors should watch out for at all over the next we've had a liquidity crisis in the the LDA pension, the LDI pensions with the gilts, and that's now hopefully been sorted out. But we've got tightening conditions out in the States in terms of treasuries. It's still the deepest and most liquid market in the world, but frankly, you are seeing things pop. Is there anything that you would sort of like to say to investors? Well, just be watching this and we're watching that, because where the next blow up could potentially be. Hopefully, won't be in small caps in UK.
Yeah, I suppose in the kind of small cap world, we touched on it earlier, you know, that redemption point of when fund managers, that is a real pressure. And it could continue. You know, we're lucky we've got closed end funds in the small cap space, and we've got captive money. So, you know, we feel exceptionally lucky at this time. But I know what it's like to be in a position where you're facing daily redemptions and you just have to sell the stuff that's good. You obviously try and sell across the board. So that liquidity can really dry up. And that could continue, I'm afraid, for quite a bit yet. You know, I'm pretty pessimistic, as most people are, for this next quarter and into Q1 next year. So it's that's one element that I'd look out for. And then, you know, when it comes to the rest of it, I'm probably, I think when we chatted last time, geopolitical risk was one of my biggest concerns at the time, and I'm still really quite twitchy about the behavior across the globe. And it's not just Ukraine, it's not just Russia. So I think, you know, there could easily be something that comes out the woodwork there. And I don't know what you feel, but I've not lived through quite a few recessions, sadly. And they don't, I'm being really flippant, they don't worry me, because you kind of deal with what you know. And with the domestic at the moment, we know that energy prices are going to be horrible. We know that Ukraine's probably not going to solve itself. We know that inflation's not very nice, but, you know, we can deal with those aspects. It's the unknown aspects that get thrown into that mix that make, I think, this particular period exceptionally challenging. So it really is just trying to block out that background noise, concentrate on what you do know, and don't try and second guess too much what you don't. Because I don't think the economists don't get it right over the long term. So how on earth can we? So that's not exactly sound advice, is it? You know,
I don't know, actually, it is pretty sage advice, because, you know, in terms of trying to price in real tail risk where you can't see these black swans coming, then frankly, you've almost got to sort of just increase your return on, you know, capital, your return you're looking forward to going forward, and as you say, buy good quality, long duration sort of like businesses that have got high recurring revenue streams at good value, and there's plenty in the Downing portfolio. And I would also highlight to investors the first point you mentioned, the redemptions. Just look at what happened to Neil Woodford about 3 or 4 years ago, because he had a big fund in small caps and was forced to liquidate, and there was a lot of his stocks that were just taken out to the woodshed. In fact, I think quite a few value investors like yourself sort of like probably had quite a good time.
Yeah, you know, so although I'm being pessimistic about it, is that, you know, if you got cash, great, this is a fantastic time. We're not being too fast when we're going into the market. We're seeing things that we like, going in bad days, picking things up. And when we're building new positions, we maybe go in previously in slightly larger position sizes, but we're just going in slowly and building up, continue to do our due diligence. You know, this period over the next year or so could be, if you're investing wisely over this next period, I think you can do exceptionally well on some really good quality names. Just got to be brave in the end, haven't you? But it's what we get paid for.
Yeah, that's right. And then if investors want to sort of like put any money into sort of Downing, is it really they can buy it obviously through the closed end, you know, sort of like investment trust, or how best to do it? Is it just through that vehicle or through others, or?
Yeah, probably. So we've got, in our small cap world, we've got three different vehicles that are slightly different for that market cap cover from each other. The real sex and violence end is Downing Strategic Microcap, which is, you know, some of the companies that we talked about today. There's also a bit of crossover with Rosemary Banyard's fund, Downing Unique Opportunities, and Josh McCarthy runs, again, with a bit more of a income bias, his small cap, mid cap income fund. So you've got a good range of funds there that you can get a slightly different flavour of small cap exposure.
Good. All right. Well, thanks very much, Judith. And as I say, really looking forward to touching base in 6 months' time, and hopefully we'll both have a bit more of a smile.
Great. Have a good time.
Bye.